Hey everyone, my name is Hoda Mer. I'm founder and CEO of Stock Card, and today I want to summarize the key takeaways and learnings from Howard Marks' latest memo, What Really Matters. In my opinion, Howard Marks is one of the best investors you can follow and learn from. He has this great habit of summarizing his thoughts and learnings from what's happening in the current market in his memos. A lot of good investors have the same habit of writing about their thoughts. Warren Buffett does that in his annual shareholder letters, as we all know, but something very special and different about Howard Marks. At 76 years old and more than $2 billion in net worth, he has no reason to keep learning and change his mind and ideas about the world, but he does it anyway. He has changed his mind about growth investing. Although he's been a value investor, especially in bonds, distressed bonds for many years, he even changed his thoughts and ideas and perceptions about cryptocurrencies. That's why every time his memo lands in my inbox, I'll make sure to put everything aside on the same day and read and learn from his memo. So today, without any further ado, let's get to the takeaways from his latest memo. Howard starts this memo by talking about things that do not matter. The first thing that he talks about is that macro predictions, macro factors like inflation rate. He believes there is no way anyone can consistently forecast the direction of macro indicators and, even more importantly, their impact on the stock market and stock prices. He believes even professionals don't do a good job at predicting and interpreting the result of those macro factors on the stock market. That's why he believes number one that doesn't matter to individual investors is trying to learn and predict the impact of macro factors on the stock market. Howard argues that the reason we should not worry about the macro factors and their impact on the stock market is that no one has been able to consistently predict those. And the reason no one has been able to consistently predict the impact of macro factors on the stock prices is that in the short term, based on Howard's point of view, stock market prices are the result of the difference between the reality and the expectation of the investors. We've seen this in companies' earnings results. We've seen the company's revenue go up, but the stock price goes down after an earnings report. And it's always about what investors expected to see in that earnings report and what really happens. That's why Howard believes it is very difficult to guess the difference between the expectation and reality, and it's all driven by psychology, and no one can predict the overall market psychology on a consistent way. He also brings some good facts and statistics from Dalbar Institute, and that in the past, for many years, every time the average return of investors is compared to the average return of the market, everyday investors on average have underperformed the market. So he says over the history of the stock market, if we've never been able to overperform the market, that should tell us something about our ability to predict the impact of macro factors on the stock market prices in the short term. Howard then continues that individual investors like you and I should not worry about the short-term results of our portfolios. He explains that in, let's say, sports, if we want to gauge the athletic quality of an athlete, we never just look at one game, the result of that one game to say if this athlete is good or not. And he brings that analogy back to investing and says, trying to predict the quality of an investor based on the result of their portfolio in one quarter or in 1 year is as similar as trying to gauge the quality of an athlete based on just one game. That means we should not make a quality decision based on the result of 1 quarter or 1 year portfolio. So if someone have made a great killing during the GameStop frenzy, or if someone has a fantastic portfolio during the latest bull market before the 2022, that doesn't mean that person is a great investor. Specifically, if you are aggressive enough, and if the market is rallying, those aggressive behavior results into higher return. And as individual investors, when we want to find those people who we want to follow, we should be mindful of that fact. Howard Marks continues his memo by bringing up the second things that he thinks it doesn't matter when it comes to investing. He believes that Sharpe ratio is a risk-adjusted return formula that a lot of investors use in order to evaluate the risk-adjusted return or potential of an equity or a bond or overall stock market. And Howard believes it doesn't matter to pay attention to Sharpe ratio, although a lot of financial media and even professionals use that. The reason Howard Marks believes that Sharpe ratio doesn't matter is because he believes the definition of the risk that we use in calculating Sharpe ratio is wrong. Howard says if you invest in a bond, for example, the risk is not the volatility in the price of that bond. The risk is that if that company that issued bond goes bankrupt and would not be able to cover its liabilities. As such, if you calculating the Sharpe ratio of that bond asset by taking its return and dividing it by the volatility of that asset price, you're basically using a wrong definition of risk. Therefore, Howard Marks believes Sharpe ratio is not an indicator of risk, and it's not something that investors should pay attention to. Continuing on the same chain of thoughts, Howard believes that paying attention to volatility is a useless activity, or basically volatility doesn't matter. He argues that if you've done your homework and invested in a company or an asset that you truly understand, the fact that the stock price is going down should not change your strategy about that company. Therefore, for long-term investors, volatility should not matter. And in times like this, in 2022, as the stock prices are crashing down, he believes that long-term investors should not worry at all because volatility is among things that they should not worry about and does not impact their overall return in the future. So here, let me pause on Howard Marks' memo and tell you about what my point of view is here. I've always believed, and actually I've learned this from Howard Marks, that investors, as individual investors, we need to figure out what our edge is over professionals, fund managers, and even algorithms. Because we don't have bosses who every quarter come to us and say, show me your portfolio's return, show me how you overperform the market every quarter, we have this unique advantage that we can close our portfolios and not to worry about our quarterly returns or even annual returns. That is our edge over every professional investor or even an algorithm. Our edge is our patience and ability not to look at our portfolio return during the market downfall. Now back to Howard Marks' memo. This section is one of the favorite sections I've ever read on Howard Marks' memos. He talks about how can we gauge the quality of an investor. It can be us, ourselves, or it can be a creator, a YouTuber we're following, or even someone that we don't know, or a celebrity that we want to follow and listen to their advice. He talks about this concept of asymmetry in return. So let's talk about that and let's understand what Howard Marks explains. I'll assure you at the end of this section, I want to take you through an example and prove to you that Howard Marks actually believes Cathie Wood, the founder and CEO and CIO of ARK Invest, is one of the best investors we've ever come across, even though her return in the latest year is not as glorious as it was actually really worse than the market. So stay tuned. First, we want to talk about Howard's definition of asymmetry and how he would evaluate equality of an investor. And then we'll get to Cathie Wood and use her example to decide whether she's a good investor or not. So let's imagine one example investor. He or she has 10% return over the market during the market rally. So the portfolio is returning 10% more than the stock market during the market rallies. And the same portfolio underperforms the market by 10% during the market's crash down. So this person, although during the good times have been overperforming the market, but during the bad time also would been underperforming the market with roughly the same amount. So this is the definition of an average investor. An average investor that has no overperformance over the market because he or she is underperforming the market with the same amount that he or she has been overperforming the market during the market rallies. So this is one example. Now, only if your overperformance of the market during market rallies is bigger than your underperformance during a market crash, you can be a better than average investor. So for example, if the market has been growing by 10% during the times that the market is in the upward trend, you're overperforming the market by an additional 10%, so your return has been 20%. Only if your return during a market downturn is less than those additional 10% is that you're actually a better investor than average. And that's what Howard Marks defines an asymmetry. So your overperformance is higher than your underperformance during the market rallies and market downturn. So that is an asymmetry of return. Of course, in an ideal situation, you would want to follow and become actually an investor who can overperform the market both during the time that the market is uptrending and during the time that is market downtrending. So you would want, ideally in an ideal world, to always stay in the green and always have a better performance than the market. But Howard says, if you ever come across an investor like that, tell me about that person, call me and let me know who that person is. I guess it's sort of an inside joke of saying that he's never been coming across someone who can consistently overperform the market during the uptrend and downtrend. So if you've been following my Roll with Our CEO portfolio, you know that I'm a big believer in Cathie Wood. But because I believe in the quality of research Cathie Wood does, and her team, of course, supporting her, as the ETF started to move downwards from its all-time high sometime in 2022, I started to adding more and more to my positions. I was very excited about doing this exercise with Cathie Wood's return. So the first period is March 30th, 2020 to March 30th, 2021. And the S&P 500 during this time period have gained more than 50%. If you look at ARKK's return during the same period, the return is more than 156%. So during the market uptrend, ARKK, Cathie Wood's flagship ETF, outperformed the S&P 500 by more than 100 percentage points. Now let's go during the period of downward trend. For this period of time, I took the return of S&P 500 for 2022 year to date. So from the start of the year to the date that I was doing this research, which is a few days back, the market has lost more than 19%. The market has lost more than 19%, and during the same time period, ARKK has lost almost 60%. So compare the 19% to the 60% drop in between S&P 500 and ARKK, and you realize that ARKK has underperformed the market by a little bit more than 40%. Now let's compare. During the market rally, the ETF overperformed the S&P 500 by more than 100%, and during the market downturn, ARKK ETF underperformed the market by 40%. Cathie Wood's ARKK, based on this example, has the asymmetry of return. It is able to overperform the market almost 2 times bigger than the underperformance of the market. And that tells me and proves to me that Howard Marks believes Cathie Wood is an excellent investor. So with that, I want to summarize what we've learned. Howard Marks is one of the best investors we came across. The reason for that is that, like many good investors, he summarizes his thoughts and learnings on a regular basis, but he's also a little bit better than some of those older investors. He actually has the ability to change his minds and his strategy about growth investing or cryptocurrencies, even though he's a wealthy investor and he's sort of older, and he doesn't really need to change his mind. He's already achieved it and succeeded in the world of investing. His latest memo is called What Really Matters, and he starts this memo by talking about things that really don't matter first. And the few things that he talked about that really don't matter are the macro factors, like what Fed would do and what the inflation rate would be. And the reason he believes it doesn't matter is that no one can consistently predict the impact of these macro factors on the stock market prices. That's why it's a useless exercise. He believes volatility doesn't matter, especially if you're a long-term investor, and if you can basically ignore the volatility in your portfolio, you'll be better off. He also believes that Sharpe ratio, which is a way of calculating risk-adjusted return of a portfolio, is useless because the definition or the formula of Sharpe ratio is the return divided by risk of the asset or the portfolio we're investing. And he believes that the way we define risk in modern finance is not right way of defining risk. And he believes that's why Sharpe ratio is not a critical factor that we should pay attention to. And then he also wrap up his memo by talking about what really matters, which is the asymmetry of return. And he defines asymmetry of return as the difference between market overperformance during the upward trend and the market underperformance during a downward trend. You are a good investor, and what really matters is having an asymmetry in your portfolio, if you can overperform the market bigger amount than even you're underperforming the market during the downturn. There you have it, folks. That's a summary of my key takeaways and learning from Howard Marks' latest memo. And as always, if you want to help us spread the world of intelligent long-term investing, like and share this video and subscribe to the channel, including the bell, so that the Google or YouTube algorithm knows the content we create is valuable and help us become available to more intelligent long-term investors across YouTube. Thank you very much for watching. I will be back with another episode of 100 Bagger stock analysis series sometime later in the week. Stay tuned and I'll see you then.